Hi everyone and welcome to Beyond Insights. Today we're discussing the importance of analyzing KPIs for your business. KPIs are key performance indicators, so quantifiable measures of performance that show how your business is performing over time for a specific objective. They help provide targets for teams to aim for, milestones to measure progress, and insights to assist members of the organization in making better decisions. So what KPIs should you be considering for your business and why should you be considering them? Well, today I am joined with a very knowledgeable person, Laurika Steenekamp, who is a CASA and our head of product support at Syft. So Laurika is our resident expert on creating KPI scorecards on Syft, tools that can help you analyze and interpret your KPIs. And she's helped many Syft users with this process. So thank you for joining us.
Of course, it's lovely to be here.
Laurika's also got lots of experience and many years of studying and working in kind of what KPIs mean. So obviously you know how to do it on Syft, but also kind of why it's important for a business. So yeah, we really excited for this episode. So what are KPIs and why are they important for a business?
So as you mentioned, KPIs are key performance indicators, which I always say accountants aren't, well, it's not that we're not creative, right? You don't want your accountant doing creative accounting, but generally we name them as they should be named. So indicators of performance that you deem key. Okay, it's the best way we can see it. So essentially, what do you consider important to your business? What do you want to measure? And obviously, in all businesses, there will be some things that are the same for every business. Every person needs cash. Every person wants to, or like we all want to make profit. We all want to have assets. So we're going to speak a little bit about those today. And I think that also ties in nicely with why they are important to the business, right? Mm-hmm. When we start a business, the objective is obviously always to create value, whether it be monetary value, whether it be whatever type of value. You're creating value for yourself as a shareholder and for your other stakeholders. So key performance indicators, essentially a way to measure whether we're creating value and how we can continue doing that going forward.
Okay,
that's how awesome. I see it.
Awesome. So yeah, maybe let's dig into kind of some of those key performance indicators. I think it's kind of, for me, it's also important just to have a goal, right?
Yes,
it's like
100%.
It's like you running this business, and then how do you know if you're actually being successful or not?
Yes.
Well, you kind of needed something to be aiming towards, and this helps. And they are like financial and non-financial, and they can be all sorts of things. But we're going to focus on kind of the most foundational ones.
Yes.
And so I think like there's probably some key areas you should be looking at for your business. So maybe just chat us through kind of those key areas.
Yeah, of course. So as I mentioned earlier, we all want to have cash, we all want to make profit, and we all want to have lots of assets. So I think our tool is nicely set up to have that on a financial KPI or KPI financial scorecard. It's really nice to see. But the three main groups we look at, essentially profitability, liquidity, solvency, that sort of concept. So profitability, very briefly, everything relating to profit. Okay. As I said, it's always in the name. Profit essentially boils down to income less expenses. So we're going to look at how much income you're generating. We're going to look at the type of expenses you have. How does your expenses look when you compare them to your profit, right? Is it even worthwhile? Are you spending money you don't really have? Because without profit, you can never really grow, right? But that being said, accounting profit can only take you that far. Right? You always need cash. I think especially in small to medium-sized businesses, cash becomes a problem really, really quickly. I mean, if I see myself as a small to medium business.
In your own personal capacity.
My personal. Yes, that's how I learned Syft, right? You just put your own.
There we go, it works,
It's financial data I understand, so let's see what it looks like when it's visualized. But cash is a problem. If you don't understand what's happening in your cash, you start having to borrow money to essentially pay people up front and that sort of thing. So liquidity speaks to the cash side of the business, how you're using your working assets or your working capital, that sort of thing. And I think I like the word liquidity so much. I've always liked it because it speaks to whether, well, obviously whether you're liquid or not, right? But do you already have the liquid, or do you need to melt down something fixed before you are liquid, right? Do you need to take an asset or something else you own that is already just standing there and melt it down to have cash?
Cool.
Or do you just have the liquid on hand, right?
That's so cool. I know we're not going into the ratios yet, but that's why there's like the current ratio and the quick ratio, because it's quick to make it liquid, so we can get there. Learning things here. Very cool. Very cool. Okay. Anything else on liquidity?
Yeah. So liquidity, obviously the working capital, as I mentioned, and we'll do some deep dive into that. But essentially, capital that's not fixed, right? Capital that you can get out and that you work with and that you operate with. So going to your current assets, current liabilities, that sort of thing. We'll speak a little bit to that as well. And then the other thing that we look at as a group or a type of key performance indicators, solvency. Because it's very nice to have a lot of cash, but it's also important that you have a lot of assets, because we want to use those assets to make a profit, to make a cash. And we need to ensure that those assets are working for us and that our debt isn't dragging us down to the extent that the assets don't help us anymore.
Exactly, because I think also you can have lots of things, but if you owe lots of money, then that's not good either, because then you can't actually like sustainably run. Okay, cool. So we've already discussed a little bit about liquidity.
Yes.
I suppose we'll go into some more about those ratios now.
Yes.
Anything else to kind of say on those points? I think there's one other area maybe also touch on. So we've got profitability, liquidity, solvency, and then that's kind of almost to kind of get you started, but then there's also growth, right?
Of course. And I think growth is such a, I want to say, a natural outflow of those things. If you have your cash right, if you're making profits, if your assets are more than your liabilities, you can almost not grow, if that makes sense. Too many knots in that sentence. It's a knotty sentence. But so growth, looking more towards what are we doing with the money that we already have? What are we doing with the profit? How are we reinvesting it? How are we measuring that growth? Like, what is important to us to look at growing the business?
No, I think that's important. And I think Alex, who writes a lot of our knowledge center articles, she always talks about like health score, because we have that in our feature. So she always compares it to like how healthy a business is and that sort of thing. And I think the way I kind of see it is you have the kind of like a very sick person who has a low health score, and then to get them healthy, they probably kind of need to focus on like profitability and like maybe liquidity, or probably liquidity, right?
Yes,
liquidity is like step one, right? Like you need to make sure you actually have enough cash to pay the people that owe you, so we can discuss those ratios. And then it's like, okay, cool, now we like breathing, like we're not like on oxygen, and so now we can maybe go and try to do a little bit more. Maybe we can like walk, like go walk around the block, and that's like being profitable. And then now we're like, okay, cool, we actually want to like run a marathon, so now we're going to grow. Maybe it's a bit of a big jump, but
I don't want to be running any marathon.
And so then that's like growth. It's like taking your business to the next level. So so maybe if we start with liquidity, what are some of those key ratios that like business owners should be worrying about?
Getting us ready for our couch to 5K. I think 5K is as far. I see that as massive. But liquidity is just getting us from like from we're very sick ill
to alive.
Yes, and I think something that I've seen very often, small medium businesses, what happens when you're not liquid enough is you come into this vicious cycle of having to borrow money to pay your creditors, and you're not getting the money from your debtors quickly enough, because and then essentially you're financing both your debtors and your creditors, because now you're borrowing money to pay someone who's given you something, and it's impossible, because now you're paying interest on something that you should have been paying in cash, and then you don't have enough cash to cover the interest, and you don't have enough. It's just a gigantic disaster, and it's unfortunately something that can happen really quickly. But the ratios that give you a really good indication of what is happening with your liquidity and whether you are actually liquid. Firstly, the first thing they always teach you, current ratio. And I used to not understand the wording for it. I'm like, current what? Why are we calling this the current ratio? Current as opposed to non-current. What is happening here? Because we call all the other ratios have nice names, like, debt to equity. It says what it is, current. So, but when you learn a little bit more, obviously, current ratio, describing your current assets to your current liabilities. And you want that to be well balanced enough, because you want your current assets to be able to cover your current liabilities. Things current assets and current liabilities, obviously items that will realize within 1 year of your financial statements or at the time that you're measuring them. So in current assets, mostly like inventory, debtors, and then cash and cash equivalents, which is money in the bank. We all love that.
Yeah, the best.
And then current liabilities, all of your short-term payables, including your accounts payable, other creditors, things like that. So you want your current ratio to be very healthy, ensuring that you can pay all of your current liabilities with your current assets. But sorry, no.
And I think when I was at Varsity, you all thought, it could be 1-to-1 because we have enough current assets for current liabilities.
Yes.
But that's not always the case, right? Because that meltdown theory, like not all things are as quick to melt down, right?
Exactly
so like
that.
Inventory and debtors, it's not really cash. Like,
exactly.
So you need to wait for them to pay you before you can kind of pay it out.
Exactly. And to that, we look at the quick ratio. Some people call it the asset test as well. In Afrikaans, which is my home language, we essentially call it the fireproof. Yeah, that's what we call that ratio. It means like, if there's a fire, will it be fine? Yeah. We're very dramatic people. Well, I am at least. I can't speak for everyone. But as you were saying, all current assets aren't created equal.
Yes.
And what happens often is that current liabilities mostly consist of accounts payable.
Yes.
Because we don't have many other current liabilities. So your entire current liabilities section consists of people that you owe money and you're going to be needing to pay them within 2 weeks or a month. And if your current asset base consists of mostly inventory or debtors, you're actually a little bit stuck. You're not that liquid despite having lots of current assets, because as you were saying with the meltdown, cash you can use immediately to pay your accounts payable. But if you're looking at something like debtors, it's a little less liquid than cash, because you first need to phone someone to tell them, listen, I need my money, I need to pay my suppliers. It's not immediate or it's not immediately available. You need to phone someone, they need to pay you. Inventory, even less liquid, because you need to actually make a sale. And depending on the type of inventory you sell, it might not be easy. So you can have a lot of your cash tied up in inventory, which is also why ratios such as your inventory turnover, which we'll also get to, is very important, because we need to understand where's your cash sitting. That's actually what am I buying with my cash? Am I buying a debtor? Am I buying a part of stock? What am I exchanging the cash for? So to get to your quick ratio, we essentially take our current assets, we delete everything that takes a long time to sell, like inventory, and then we compare that to our payables, to ensure that we can cover our payables with cash and debtors.
Okay, cool. And so like that tells you kind of how healthy your liquidity is. But then you can almost see like, okay, how bad are those debtors and how bad are those inventory and how bad are the creditors with the days, right? So debtors days, credit days, and inventory days. So like what would you be looking at when looking at those ratios?
Okay, great question. I love it. I used to teach this at Varsity. So those things all relate to your working capital cycle. Working capital as opposed to like fixed capital, capital expenditure. So the things that you operate with on a daily basis. And when we speak about working capital, we essentially look at those things you mentioned, right? Inventory, debtors, and creditors. And we calculate days for each of those and then net it off to see how long my working capital cycle is. And why is this important information? It's essentially telling us how long does it take me to complete one cycle of getting inventory, selling it, getting my debtor to repay me, and repaying my supplier for that inventory that I bought for them. How many times do I do this in a year? How long will it take me to have cash in the bank, right? So essentially all of those ratios are basically the same. We take the income statement effect, we divide it by I'm lying to you. We take the balance sheet effect, divided by the income statement effect for the year, and express that as a ratio or as a number of days by multiplying by 365, right? Because we're saying how big a portion of our sales is currently sitting in debtors. So important things to look out for there is your debtors, like how quickly your debtors pay you, your debtors days, ideally should be as short as possible, and your creditors' days ideally as long as possible. We always want people to pay us back before we hand out the money again.
Yeah.
Reason for that is simple. If you have cash, you can invest the cash short term, money market, whatever you're doing with it. You can get interest on the cash that isn't necessarily your cash, and use some of that interest for reinvestment, whatever. It's just another way to make money. So it's not always easy to get your debtor cycle to be 3 days and your payable cycle to be 70 days, even though everyone would like it. The problem is everyone likes it.
Yeah, we want to be paid early. Yeah.
Exactly. And if I'm your debtor and but you are my supplier, right?
Yeah, I want to be quick.
Yes, you want me to be quick and I want to not pay you.
Yeah.
So it's difficult to get that balance right, but it's very important, if you can manage it at all, to have your debtor days be shorter at least than your credit days, so that you're not financing your debtors, because otherwise you're basically borrowing money to ensure that you have debtors as an asset,
and I think
should just be paying you.
This is an important one. Like it shows the importance of like monitoring your KPIs, because it's like, okay, my debtors days, like you'll probably have a policy, everyone should pay me in like 30 days or whatever, or like that's like your standard practice. And then all of a sudden, if now you know monitoring this metric and maybe using a graph, and you're like, oh, it's 30, 30, 30, 100. You're like, what went wrong? Did my debtors lady go on leave and forget to call everyone? Did what happened? And so that's why it's really important to monitor it, because if you don't like find out, like if you don't know that there's an issue, you can't solve it.
Exactly.
And so it's kind of an indicator of your key performance, but good to track it.
100%, because you had the example of your debtors lady going on leave, right? That is actually so important and so relevant and so common. Our debtors aren't paying us because we're not telling them they should be paying us. Yeah. It's almost a thing about the one who shouts the loudest will get helped first, right? Send those follow-up emails, because people forget. Yeah. They're not necessarily trying to ignore you or be difficult. It's just, goodness, I forgot to pay the plumber. I shouldn't have done that. But when they send that little follow-up email, you are reminded and you can pay them. So that's actually, in my opinion, one of the easiest ways to start controlling your debtors better. Just start phoning them. Yeah. You owe us money. You can obviously also set up some agreements with your suppliers. Yeah. Say, listen, I can't actually pay you, or this is a really big order. Can I pay it over a period?
Long. Okay, cool. So now hopefully if we're tracking all these things, our business can breathe. Yes. And now we want to maybe go for a nice stroll around the block. Not doing a 5K yet. And so we think of like profitability then, right? And we're like, okay, how can we make our business more profitable? Yes. So what kind of maybe 2 or 3 ratios should we think of for that?
Favorite metrics for profitability. I am quite partial to like a operating expenses ratio. Okay. I do like that one. I think the reason for it is I audited OPEX a lot of times when I was auditing. You just get to know that section of the income statement really well. But you also get to know that there's a lot of stuff just hiding in that section that you're not very aware of necessarily. It's just sort of that little subscription you signed up to 2 years ago, and they're deducting $70 from your account monthly, but you're not really checking it, that sort of thing.
This podcast is brought to you by Syft Analytics. Syft Analytics is an interactive and collaborative financial reporting tool that helps you generate beautiful reports, forecasts, and consolidations in just a few clicks. Syft helps you increase revenue, reduce costs, save time, and look professional. It is also enhanced by AI-powered insights that help you go from data to decisions in no time. Want to find out more? Visit our website at syftanalytics.com to start a 14-day free trial today.
OPEX ratio, just expressing how much operating expenses you have. Also, as you were mentioning with the debtors days, if you see a spike, you can go and investigate. So it's the same with the operating expenditure. Did your OPEX ratio change because of a change in the operating expenses, or because of a change in your profit or revenue? What happened that made a change? Because sometimes your expenses are actually controllable, but you can't really save yourself into a profit.
Yes,
right.
No, you can't. Yeah, you have to, if your sales increase, your expenses would probably increase.
Exactly.
But it's just like, is it in the same ratio?
Exactly.
Or not? Yeah.
Exactly. It's fine if your expenses increase. You shouldn't be scared of an increase in expenses. You should just have a related increase in sales. Yeah.
Yes.
So I think OPEX ratio is something that we generally check. And then for profitability, probably pretty old school. I like gross profit and net profit margin, both of them. And I like using them concurrently together because you can see, like, let's say your gross profit margin is 70%. Fantastic. But your net profit margin is only 8%. What happened to all of your profit?
Yeah, exactly.
And it's sort of the same as looking at your OPEX ratio, right? But because of the fact that the below the line expenses will cause this drop in net profit percentage. But you always want your gross profit percentage to be extremely stable.
Yeah.
Because otherwise it means you're probably costing wrong.
Yeah.
Your cost of sales is incorrect per item. But the play between the gross profit percentage and the net profit percentage is a really nice one to just monitor, because everything in your income statement should be pretty stable unless you know that it won't be,
and then you should know why.
You should know why. Exactly that.
Okay, cool. So hopefully we are breathing. We've gone for a walk around the block. Our business is profitable, and now we want to go and try for that 5K, not the marathon, because we're not very healthy or fit. But we're talking about like growth, right? So like, what should we be looking for when we're really thinking about growth?
That's a good question. I think it's that I think there are a lot of things that you can look at. Firstly, we want to always see a good uptick in profit, right? I think it's important to look at your profit percentages, net profit especially, because that's ultimately what it boils down to. I sometimes adjust that a little bit for events that were once off, right?
Yeah, fair.
Because if it's something unexpected that we don't really, it's not commonplace for the business to have that. You shouldn't really take it into account when doing like a year-on-year comparison or whatever. So checking whether your profit increase is a nice
so like just
place
growth in the metrics we looked at,
metrics
or reduction in the metrics that are bad, like
exactly. Exactly that. Good. Another thing that I like. Cash balance.
Okay.
Do you have more cash?
Yeah.
You need to understand the cash balance though, because sometimes you have more cash because you're not investing the cash correctly.
Yes.
So
too much cash is not always a good thing.
Exactly.
But too little is definitely a bad thing.
Exactly that. So if you can see a pretty stable improvement in your cash balance, but you are doing the same type of investment or investing activities that you have been doing, I think that can really give a good indication. Another thing that we like looking at, return on equity, return on assets. So essentially, if you take the profit that you made in the year and you divide it by the amount that you invested, whether that be in equity or in asset, right? Because your assets ultimately are just what you invest. All the equity and all the liabilities should equal your assets. So it just shows you all the money you spent to get this business going, right? But those type of ratios give you a really good idea of whether your business is growing. Because if my return on equity improves and my equity didn't change, it means
you're going in the right direction.
Direction.
Okay, cool. I think that's a good one. So it's kind of like movement in the metrics in the right direction, as well as like what's the return. I think the other one that they talk a lot about is like EBITDA.
Yeah. That's actually very fair. Great one. So EBITDA just being your earnings before interest, tax, depreciation, and amortization. The reason we eliminate those items is because they're accounting and they're really important for accounting, but they aren't cash items. So EBITDA is essentially just getting you to, I want to almost say, a cash profit. It shows you what you really made. If you take your sales and your cost of sales and everything that you spent to get to EBITDA. I think I like about it is it's kind of like more the things you can control. Like 100%. You can't control the tax regulation or the interest rate,
and you like depreciation and stuff. It's a rule. So it's kind of like, okay, did I do well with what I can control? So I think it's good. Okay, cool. So I think we now are running a 5K, and I think solvency. You just said like, are you solvent? I think that's probably less important for a small business.
Yes. Because I mean, if you're not in May, that's just also a really nice thing to check. But I haven't seen many businesses with liabilities greater than their asset total.
Okay, so we
Not
won't focus
really.
on that one too much.
No.
Also
no,
because we're running out of
it's
time.
It's generally fine.
Okay, cool. So I think we had a good rundown. We are out of time, and I think hopefully you have some ideas of like how to take your business from unhealthy to marathon running, and some metrics that you should be tracking. And there's lots of great tools out there to help you do it. So hopefully you learned something. I did, and have a great day. See you next time. Bye.
Bye.
Thanks for tuning in to the Beyond Insights podcast.
Please like and subscribe on whatever platform you're listening to right now.
And please share with any of your colleagues or friends or family members that you think might benefit from listening to this podcast.
That's all from us. Until next time, see you then.